Welcome to This Explainer. Okay, today we're diving into a pretty wild financial detective story. If you've been watching the precious metals markets lately, you're probably feeling a bit of whiplash. You see the surface level prices fluctuating, sometimes dropping pretty hard, and it's super easy to get discouraged. But what if I told you that the price action you're seeing on your screen is basically an illusion? Today, we're going to figure out exactly why the smart money, we're talking the most well-informed players on the planet, absolutely prefers physical gold over paper contracts. We'll see how they're quietly accumulating historic amounts of the actual physical metal, while the rest of the market is completely distracted.
All right, let's dive right into this. I want to start with a number that should absolutely grab your attention. $13 billion. That is the staggering value of physical gold delivered in just a single month, June of 2026. And to be clear, this isn't just paper trading back and forth on a screen. This is actual, physical metal being removed from the exchanges and locked away. It's a massive anomaly, and it really sets the stage for our investigation today. Because honestly, something monumental is happening right beneath the surface of those falling prices. So what does this all actually mean? Well, industry experts who watch this stuff every day, like Andy Schectman, kind of hit the nail on the head. He pointed out that price is just misdirecting, and the people standing for delivery, they know the playbook. See, while everyday investors watch falling prices, panic, and hit that sell button, the smart money is actually using this exact misdirection to their advantage. They're taking those lower paper prices and quietly, aggressively piling into physical metal. They know exactly what game is being played here. Ultimately, it's about understanding the massive wealth transfer happening right in front of us. On one side, you have the weak hands. These are the speculators driven by emotion, exhausted by the volatility, just selling off their paper assets because the price dipped today. And on the flip side, we have the strong hands. These guys do not care about today's price tag. They're using this environment to buy absolute physical control at essentially subsidized prices. It is a historic repositioning of assets. Let's look at the hard data in Section 1, record-breaking deliveries. The silver market brilliantly illustrates how crazy this anomaly is. In the entire year of 2023, we saw just over 23,000 contracts delivered off the COMEX. But get this, in just the first 5 months of 2026, from January to May, we saw almost 34,000 contracts delivered. That is roughly 170 million ounces of silver, physically moving. To put that into perspective, deliveries were 45% higher in a mere 5 months than they were for an entire previous year. And gold, it's the exact same story, just with much bigger numbers. Between January and May of 2026 alone, roughly 99,000 contracts of gold were delivered off the exchange. That translates to about 9.9 million ounces of physical gold, representing a jaw-dropping value of $45 billion. Again, this is all happening right as the surface price is supposedly getting kneecapped. The desire here isn't to day trade. The desire is to take actual physical ownership. Which brings us to Section 2, paper promises versus physical bars. For a really long time, the old normal was perfectly fine for most investors. People were completely happy holding what we call paper warrants. These are simply financial claims to an asset, basically an IOU. They serve as a promise, usually settled in cash, and the physical metal itself never actually moves an inch. Historically, deliveries averaged less than 1% of the contracts issued. But, as you'll see, that era of blindly trusting paper promises is rapidly coming to an end. Right now, we're seeing a really violent shift in sentiment, away from paper and straight back to physical reality. Paper promises are convenient, sure, but they are incredibly vulnerable to counterparty risk. If the financial system stresses, that paper might literally just burn up. So the smart money is saying, no thank you, I want numbered bars in my vault. They want absolute ownership and true control, completely removing the counterparty risk that's built into our over-leveraged systems. Now, who exactly is driving this? Let's jump to Section 3, central banks buying the crash. What's really interesting here is the sheer scale of the misdirection at the institutional level. The central banks told the world in their official quarterly narrative that they bought about 15 tons of gold. But, according to the World Gold Council, when you trace the actual metal flowing through the refineries, the real number is 244 tons. That's literally more than 15 times the official number. It's like someone in accounting just conveniently forgot to carry the one a few hundred times, right? They are quietly buying the crash and absorbing physical metal while everyone else is distracted by the surging dollar and inflation headlines. And believe me, they aren't doing this blindly. Central banks have been stockpiling over 1,000 tons of gold a year for 4 straight years now. And the reason why? Well, 74% of central banks actually expect the US dollar's share of global reserves to fall. This isn't market confusion. This is calculated, highly strategic positioning by the deepest pockets on Earth. The motivations behind this sovereign buying are deeply tied to our current global realities. You've got mounting concerns about inflation and an incredibly over-leveraged financial system propped up by decades of artificially low interest rates. Plus, the freezing of Russian treasury assets sent a massive shockwave across the globe. No matter what your politics are, objectively speaking, nations watch that happen and realize that relying on a traditional fiat system where someone else can just turn off access to your wealth is a huge vulnerability. It's bred a massive amount of distrust. So, what are they building with all this metal? Let's check out Section 4, Rebuilding the Global System. These central banks aren't just hoarding gold to sit on it. They're executing a very deliberate blueprint to build a new multipolar financial landscape. Step 1 is launching alternative payment networks like SIPs and the new M-Bridge system. Step 2 is opening physical precious metal exchanges worldwide that actually connect to those networks, which leads directly to Step 3, allowing countries to use their own local currencies, but then settle any international trade imbalances directly in physical gold. And you guys, this infrastructure is popping up everywhere. It isn't just a theory, it is happening right now. We're seeing new physical exchanges acting as the main arteries for this whole system. Dubai is issuing immediate delivery contracts. Singapore has new deliverable contracts for 1 kilo gold and 1,000-ounce silver. Hong Kong is setting up brand new settlement systems, and the Shanghai Exchange is aggressively expanding through the Global South and the Belt and Road Initiative. All of this demands physical metal, which perfectly explains why Western vaults are draining so fast. If you take away just one thing from today's explainer, make it this. Gold is the only asset where ownership still means ownership. In a world completely drowning in debt, where owning a bond or a paper dollar doesn't actually guarantee you control, physical precious metals offer a real escape from counterparty risk. That is exactly why countries like France are demanding their gold be repatriated. They're saying no to the convenience of the New York Fed and bringing their actual physical bars back home. It is a slow, methodical transition, which makes it really easy for day traders chasing quick paper profits to just dismiss. But the smart money is playing a much longer game. As the source material beautifully puts it, long after the fiat money currently sitting in your wallet is hanging from a frame in the Smithsonian as a historical artifact, gold and silver will still have an active, vital role in the monetary system. They are being completely reintegrated as we speak. Which leaves us with a pretty critical question to ponder. If the most powerful, well-informed central banks in the world are using price misdirection to quietly trade away their paper wealth for record amounts of physical gold, what does that mean for the paper in your wallet? It's absolutely something to think about as you evaluate your own financial security. Thank you so much for joining me for this explainer, and remember, keep your eyes on the physical reality, not just the paper illusion.